Welcome to The Missing Link, a podcast where crypto and insurance come together. I'm Dan Roberts, and my co-host is Danielle Wall-Elliott. Whether you're in crypto, traditional finance, or in need of a new podcast, The Missing Link will help you explore the vital role that insurance plays in crypto and how blockchain will disrupt insurance. Join us on our journey to find the missing link. Hello everyone, today we have Brian Mosoff, CEO of Ether Capital. He takes us through the importance of staking. Ether Capital do a lot of that, so how the ecosystem is developing, including the risks around centralization there. The differences between running a validator as an individual versus as a company, and that risk versus reward in crypto. Is it better to just hold and do nothing? The hodlers perhaps would agree. We also liked his missing link. Spoiler alert, it could be you. It was a great conversation. We're very grateful to have him along. We hope you enjoy the conversation.
All right. We have a great guest here on The Missing Link today. Brian Mosoff is a blockchain and cryptocurrency expert. He's the CEO of Ether Capital. And Brian has been actively involved in the crypto industry for a decade and helped launch the world's first spot Bitcoin and Ethereum ETF alongside Purpose Investments in 2021. You are very active in the space, especially in Canada. You're the president and founding member of the Canadian Web3 Council, and definitely have seen you around in the regulatory space as well. We have you here as an advisor to both the Ontario Securities Commission and the Investment Industry Regulation Organization of Canada. Welcome, Brian. We're so happy you're here with us today.
Thanks for having me, and always happy to chat anything crypto, regulation, what's happening in this space. It's actually been over a decade. I think at this point, it's getting tired, very tired, but happy to be here.
Those bull and bear markets seem like they last longer. So they always say crypto years are like dog years. So you're basically ready to retire.
One thing I will say, though, about space is that once you've been through multiple cycles, not just a single bull and bear, your perspective starts to change. You see how the narrative and the wider global set of eyes who don't eat, sleep, and breathe this stuff, how are they thinking about the space? And how are they starting to accept that it's here to stay, or that they see that the price volatility is just in some short 1 to 3 year window? So that's a really, I think, special and unique thing from being basically a dinosaur in crypto.
Yeah, I think the number of people that have been around for 10 years is a reasonably low number. So yeah, great to have you here, Brian.
Thank you.
Nice to hear some additional expertise on the regulatory side as well. I'm sure we'll get to that. You've got a great CV in that regard. To kick us off, however, we'll do our lightning round. 4 really quick questions. Keen to just take a stock take of a little bit about who you are and how perhaps you fit within the way that we think, which is around insurance and crypto. So, first one is with brief explanation or not. How would you rate yourself in crypto 1 to 10?
Like as a nice person, as a crypto knowledge, nice person. I think I'm on the nicer side. I'd say an 8. Nice. We can always all be nicer, especially on Twitter. In terms of knowledge, I would say that I'm somewhere around a 7. I recognize that there's just so much that's constantly evolving to keep up with. It's just impossible. I'm also in one very specific part of the ecosystem, which is Ethereum and kind of the Bitcoin narrative. So what's happening on competitor layer 1s or inside of the roll-up landscape and all these new developments that are coming is where I really should spend more time researching. So got to leave yourself some room to always be finding out more.
Fair enough. Nice to have our first rating of niceness as well, which is good to hear. Twitter brings out the worst of most people, so don't.
You need an in-person nice rating, and then you need a Twitter rating, because those are different things.
Create an entire matrix of nice ratings across different social media platforms. We'll go for it. And then, obviously this is name specific, but how would you rate yourself 1 to 10 on the insurance landscape? And not as a nice person, more of insurance knowledge this time.
In insurance knowledge in the space, I would call it a 5. I understand where we're looking at insurance in relation to running a corporation that's public structure. Ether Capital is public, how we look at our treasury, and then how we think about insurance inside of the Bitcoin and Ethereum ETFs that trade in Canada on the TSX. And we did a fair amount of looking into insurance at that point. And so happy to dive into that later. So I'd say a 5.
Absolutely. Great. Next one, what sort of project are you keeping your eye on in the Ethereum space?
I think the thing right now for people to be paying attention to is what's going to happen with rollups, layer 2s, what happens to competitor layer 1s. Do those really just become rollups onto Ethereum? And this idea around data availability, and are we all converging Cosmos and Ethereum into kind of the same security model? It feels, if you went 5 years ago, Ethereum, Bitcoin, Ethereum, Polkadot, Cosmos were doing different things, and maybe Cosmos and Polkadot were taking a similar approach. But I think that things are starting to converge, and that's really interesting to think about. How is this going to play out, and where value is going to accrue? Especially important for people that are looking to invest in native tokens. Which token has value accrual? Where will those fees go? Who's going to collect them? How you stake? Should you stake? What are you staking? That to me is, I think, a big area of focus. And then I'm just personally very curious on the privacy front to see what happens with ZK. Never seemed intuitive to me that we don't have privacy as an option at a base layer. So that's something that's very interesting to me.
Got you. So yeah, some positive trends going on. What sort of trend would you like to see exit the space?
Exit the space?
Yeah, the trend that's around that you could do with seeing the back of.
I think that we're about to hit in the next cycle. I think a lot of the meme coins and layer 1, the meme coins in the layer 1 trying to compete with Ethereum and rally their own infrastructure from zero is going to go away. People will start to focus their efforts on where there's real building communities and infrastructure. That I'm excited for. In the last cycle, where you read all these headlines of whatever chain is going to be the next ETH killer, or ETH is dead because of whatever. And I say this, of course, like as an Ethereum bull, and I run Ether Capital, but I genuinely think, at what point do people realize there's so much infrastructure built around Ethereum, you can't just duplicate that somewhere else easily. You've got, a 200 or $250 billion market cap, trillions of dollars clearing through a platform. I would like to see some of that building just happening where they can leverage existing communities to build better products. Doesn't mean that there won't be other things that are good that are out there, but I think we can move to what's really happening here long term, and let's focus there. And that's better for investors who really don't know how to navigate the space, that feel they missed out on the price appreciation of Bitcoin. If they're new to investing generally, they'll maybe say things like, "Oh, Bitcoin's already $30,000. It's too late. I don't want to buy that. I'd rather have like 1,000 of this other thing I could get for $1, or Shiba is going to be the next Dogecoin." But they haven't done any of their homework. They haven't read about why it will or it won't. They don't know anything about what the community on those specific projects are trying to achieve. And so I'd like some of those projects or hype coins not to make the same level of waves, because I think it's just better for everything. It's better for the industry. It's better for the regulators who are looking in and saying this is too much of the Wild West that needs to be stamped out. And then it's better for the investor who said, "Oh yeah, I put $1,000 into whatever other meme coin and I'll see what happens." And then 6 months later they say, "Yeah, I'm not buying crypto ever again because it didn't work out." Well,
I have so many stories of that with my friends that are in the space, and then their families. It's like, we've been telling them for 8-9 years to buy Bitcoin or buy Ethereum or whatever it is. And they're like, "Hey, I finally got into crypto. Oh, that's amazing.
I bought Shiba.
I bought Shiba. I bought Dogecoin." You're like, "Oh man, like, come on, please." Yeah, it's hard to battle that. It's hard to battle a cute little dog coin with just like cryptography.
Which is a strange thing to say. Yeah.
Well, there was the I can't remember the name of the guy who invented Dogecoin. This is back in 2013, and he did it as a joke and kind of just a statement, not for it to be a real thing. And here we are years later, where Dogecoin, I think, is still in the top 10. by market cap. Certainly, it will be in the top 10 if you remove probably all of the stables from there. But he didn't like it. He made some public statements on Twitter that Dogecoin was not meant to be what it's turned into. People shouldn't be putting real money into it and taking it seriously. So, as you said, you can't fight a cute animal on a crypto token.
Yeah.
That's the kryptonite of the space, a cute animal on a token. It's, for as long as there's an incentive to start anything at all, even if you're competing with a large ecosystem, that'll be there for, anyone to take a crack at. And you would like for that incentive to go down as these ecosystems become more comprehensive and difficult to overhaul. I think it's good that there's been that kind of competition, but there's some really interesting ways now that you can collaborate with these ecosystems by building something just as unique and with just the same incentives to yourself and your teams and your investors, but in a way which is conducive to the existing ecosystem and not sort of fighting against it. Thank you for those quick questions. You mentioned staking. Ether Capital is a big staker. You talk about it a lot. Would love to hear about, what your motivation is for kind of being more dedicated on the staking side. What's the sort of ethos or mentality that came behind that decision, and where are you at today?
So Ether Capital goes public in 2018, has one of the largest treasuries of ETH, especially in the capital markets. And what's unique about Ether Capital, or one very specific thing, is that we're not a fund, we're not an ETF, we're a corporation. And we're allowed to use that treasury kind of however we see fit. We can invest, buy, build, or we could take that treasury and make those assets productive and help secure Ethereum, and then generate a yield and pass that revenue back into our treasury and ultimately to the shareholders. But that was something that was very important to us, that we saw that holding on to a lot of Ether long-term is going to be very valuable. We believe in the asset generally. We believe in the ecosystem. We've never wavered from that. We've never divested into other L1s or into Bitcoin. I'm not against Bitcoin. I'm very excited about Bitcoin just as much as Ethereum, just for a very different set of narratives. And so when staking came about in December of 2020, the launch of the Beacon chain, we decided to deploy one single validator as a test, just to see how is this thing going to work. How would we do this inside of a public structure? It's one thing to be someone at home, like Brian sitting at a kitchen table with a ledger or whatever hardware device people are using, and saying, I'll put it under my bedside table. If anyone wants to come and rob me, it's not under my bedside table, so don't bother. But it's a different set of workflows and contemplations when you're in a public structure and you have to start thinking about what is appropriate for something of this size, a reporting issue, or how are you going to put that on your accounting books? How are the auditors going to look at it? And so we wanted to deploy one validator just to run through that process, document it, understand it better, get comfortable with it. And then also message to the market what we were doing and what we thought the future of Ethereum was going to be. So later, we deployed over time an additional 36,000 ETH of our treasury into staking, which is well above 50%. And we're in the process now of moving towards as close to 100% as possible. We had a third-party partner for the first batch of our Ether, which is Figment. And now we are spinning up our own servers, which is bare metal in data centers. We believe in network diversification. We believe that you need geographic diversity, and that the only hope for Ethereum long-term is going to have to be that it remains politically neutral. So we can't have concentration into just single cloud providers, single third-party providers. I know a lot of people right now are focused on Lido and that there's only a certain number of node operators. The reality is those node operators also operate for the exchanges. And so it's more than just what's through Lido. It's also who their exchange providers are. And these are great node operators. They're great partners. They're great staking service companies. No question. I'm friendly with all of them and they have great products. But Ethereum generally needs people all around the world at home, more businesses to be able to stake. And so we felt at Ether Capital, we could contribute and do the best thing for our shareholders by spinning up our own infrastructure. Now, with that, of course, comes, again, a lot of that documentation and workflow and figuring out how we would do this, legal analysis on exactly what the activity looks like. You're processing transactions that you don't really know what they are, and that has some contemplations to it. So staking is really exciting for us. I'm curious to see where things go in terms of opportunities like restaking. Things like Eigenlayer are really interesting to us. We're hopefully going to join some of those operator calls and see if it's something that we can look into. And so I think that landscape is going to continue to evolve, and just deploying validators with 32 ETH, whether they're yours or someone else's, is just scratching the surface of what the long-term opportunity here is. And staking really is a base layer core piece of infrastructure that we think is going to be key if we're going to have a global settlement layer here processing trillions and trillions or hundreds of trillions of dollars worth of transactions. So having this mind share in-house and ability is very important to us, and something we're very excited about.
What should the Ethereum community be concerned about? Like you're saying, this hot topic right now of staking as a service, taking up, too much of the market share of staking. What is it? Is it that they can, what is their solution? Can it be one company, one project that does it in the right way? Or is it that it does need to be diverse in even projects?
I think it'd be great to figure out how you can lower the barrier to stake at home. I have a DApp node at home. Shout out to the DApp node peeps if they're listening. It's still very difficult. It's still very confusing. And so a lot of people are just going to open whatever wallet, they'll click a button, they'll send their ETH to a liquid staking protocol, and off they go. We have to figure out how people can, either we lower the amount of ETH per validator, and I'm not going to make even proposals here because I'm not a researcher and there's reasons why they're doing things, but I do think it's still very difficult to stake as an individual at home. If you're technical, you go, it's not that hard. You just download the software and you run this and you plug it in, and then you use ETH Staker dashboard, whatever, to monitor. It's like, sure, maybe, but that's not really the way to diversify by just mom and pop at home being able to do this. I do think that the staking pools have gotten larger than people anticipated, or maybe very quickly before they realized where there could be some holes or some risks there. And so I think that's a real risk, is that we're going to start adding leverage where people will then take that LSD, that liquid staking token or derivative, whatever people want to call it, and then go off into DeFi and then lend it or trade around with it. And so we've seen time and time again through traditional finance and in crypto that leverage ultimately doesn't usually have a good end. And so that's a real risk here. I think a lot of people are concerned about the slashing and the offline risk. Yeah. So far, I haven't seen that to be a meaningful risk. I calculated if you miss an attestation, so per block is I don't know, what is it, like every 12 seconds, it's about 2.1 cents US. It's not a meaningful amount of money. So if your node goes down for 5 minutes, fine, you missed out on 15 cents or 20 cents of rewards, whatever it crunches out to be. It's not meaningful capital. And then again, if you're online for the same amount of time that you were down, then you would be more or less neutral. So the downtime risk for not having a T3 connection in a data center is not really that big of a deal. Slashing, I suppose, is, but we haven't seen yet real slashing at scale. Now, maybe it's still very early days. We're still kind of in the first year of big ETH being staked and in a post-merge environment. So maybe we'll see an attack of some kind on one of these service providers where there's meaningful slashing events. But so far, even that still seems quite low. I would say that kind of
ties into this insurance space. Like we're seeing this pop up. I recently watched a webinar with like Figment and Nexus Mutual, and they're Nexus offers I think both slashing like a slashing product for insurance, but they were kind of trying to assess the risk there. Is it really a risk? Is it really something that you do need to insure? And I think that's like part of our take on this. We do think there needs to be more insurance in the space, but what parts actually need to be insured? And yeah, do you have any insurance in your staking? With having so much stake, do you guys insure any part of that?
No, we don't. And I'm not sure if you can get staking insurance that are really at scale. When you start digging into how a lot of the insurance companies work, it's kind of off their own balance sheet, similar to, at least in the early years, a lot of the custodians that had insurance on their cold wallets. You realized, well, there's $200 million across 40 billion of assets. Is that really insurance? I mean, I'm making a joke here, but I would say ultimately that the insurance is zero. Like if $30 billion goes missing because there was something wrong in the setup or how they generated the entropy to create the seed phrases or whatever they were using, $200 million is not going to go a long way. And the companies were more or less doing self-cover. And so those companies would sink along with all of their customer assets. That is a real risk to me, is finding a way to ensure, if there's some way to at scale insure not just $1 million of your Bitcoin or your ETH in some cold wallet, but we're now moving into the BlackRock era, the Ether Capital era of, we have $100 million now sitting in a treasury. How do you ensure that one-to-one? Not we've got $5 million of cover. It's like, no. I want to know that I could have $100 million of cover, or the ETF is one-to-one, and it's not, 2.5% a year or 1.5% a year. Yeah. It's just too much drag. And so you won't end up doing it and you leave it on the table. Yeah. So that's something that we need to see. And I'd also say that another risk that we didn't quite get into, because I think you're right in that people are overweight the risk of slashing and offline time. But one thing that people don't seem to be concerned with, and you guys tell me if you agree with this or not, custodians, we know what they do. They're holding the private keys to the assets. And if you have a staking provider on a third-party staking provider, one way that I think about this is they're generating this key store file, and that with that key store file, they're signing blocks, they're doing attestations, whatever. But if they can't steal your assets, fine, because they're not doing the custody of the cold storage assets. But they also, though, are required to sign your exit transaction. And so if something happens to that third-party provider, they become insolvent, they screw up, you theoretically never get your assets back. And so to me, the staking providers do have a duty of care that may be similar to custodians without the industry quite realizing it, right? Your assets would just get locked with no way to exit. That's something that I don't think is quite on the radar of a lot of people and companies. And as institutions start looking at building staked ETH products, I think is very important to figure out how you're going to manage those key store files and not just say, our custodian checked all the boxes we like, but yeah, we have a great staking provider. It's like, hold on, you realize that they're also almost equally as important as the custodian, because if you ever want the assets back, you're going to need to make sure that they're in business. Yeah. That's something that I don't think
kind of to your point about custodians, like they can't find enough coverage. I think that the industry needs to have, more in a movement of, yes, let me protect my own assets. Let me get a smaller policy for me as an individual when I want to put my assets, with a large custodian. I think that, we can see, something like when you buy furniture on Amazon, when you buy your flight insurance, embedded insurance, just to say, hey, do you want to insure that? I think that's the path forward for, rather than try to insure 10 billion at FTX. Like they're not going to do that. They don't have the capacity right now. But me as an individual, I maybe need to start thinking more about how to protect my, because I'm not saying custodians should just go away. We need them in some ways, but then, how do I assess my own risk and decide, when to insure?
And you also need the user, whether they're an individual or retail level or an institution, to understand what they're being insured for. And you can think about all the things that have gone wrong in the last number of years. It wasn't necessarily just that the custodian went away because the exchange became insolvent. Maybe it's you moved the asset across a bridge without realizing that there was a risk to the bridge that you touched. Yeah. is that something that's wrapped into the same policy or something else that you could buy? You need the sophistication of that user to understand all these different things about what could happen to that asset. What if there's a fork and the exchange decides not to support the fork? What happens then? And so all these things
they do support it, and they take your other forked assets as their own.
We've seen that many times in the history of the space. Or there's a scenario where the fork happens and then it gets supported by the platform later, but the big spike and the price appreciation of asset number 2 or whatever it is was in a very short window, and it wasn't supported by the platform or the specific platform you chose. And so you missed out on being able to sell it when you wanted. So that may not be, the highest priority for insurance, but it's still there. It's still on the table of somewhere at the bottom of the menu of, what sides do you want? I'd like some fries, and I'd also like some insurance on all these other weird things that happen in crypto. And they do happen.
Exactly. I think the insurance side obviously gets easier the more time goes on, because you're able to find, the regular losses that allow you to combine these kinds of products so that you can have diversification. You mentioned $100 million, having that covered 1-to-1, and a rate online of 1.5% or lower. Mathematically, it doesn't really work. Either you have a catastrophe program where the rate online is 20%, 15%, and the demand is there because these reinsurance companies are basically shifting a lot of tail risk off their balance sheet, and so it's worth the premiums, or insurance companies. Or you have a scenario where you don't have, or you have a scenario where you have lots and lots of people in the position where they're wanting to cover that 100 million, that an aggregate policy can be created where it can be leveraged, and you're covered. You're not covered 1-to-1 in terms of capital. The specific $100 million is sat somewhere covering your specific $100 million, but you do have a policy for $100 million, which covers all your assets. It's just coming from a pool that is also covering a number of assets, and sufficient diversification there to to bring you that 1.5 rate online. And then, another challenge here is that there's lots of new types of risk, bridging and slashing and so forth. And insurance is a, law of large numbers industry. So all of these new kinds of risks that are coming through are almost in a beautiful way being able to be experimented on, because we have these DAO type structures where you can spin up a new pool and have people, the market can determine how much demand there is almost, in an ideal world. It's as good as it gets essentially in the DeFi space, to see what kind of demand for different types of risks, this new type has. And then from there, we can start to see losses and, build out these scalable programs where people can get, very cheap, protection, because there's been decent losses, and it's experienced enough globally, at scale for that kind of capital efficiency to happen. So, kind of touching on Danielle's point, insurance it's the reactive part to protection, and it seems like there's a kind of human part and a proactive part that the industry is able to take, because it's so digitally native that there's all sorts of cyber controls and security that we can do to minimize these kinds of risks. And then when the new ones come in, obviously it sort of bursts these new interesting, dilemmas. And something that's, so interesting is that when these new risks come about, they're very, very specific for some players who would, pay a decent amount for that kind of protection, but almost no one else cares. And so there isn't that, aggregate opportunity for reinsurance companies, insurance companies, capital markets, to deploy a decent amount of sums that, they're interested in making 10, 12, 15%, annualized return.
You guys both mentioned bridging as well. And it's like, that's a new area where there's 15-second policies. So you can have this capacity that can write so many more policies than it would have, in a traditional space where it's like a 12-month policy or something. So I think that's cool too, that because of the nature of blockchain and just that we're in this digital space that's so new and innovative and moving so quickly that we're seeing these new insurance programs pop up. A 15-second policy, like who would ever think that that would be actually valuable?
And you'll see institutions or the custodians first lean into different insurance offerings and push it down to customers. Institutions would love to have this as we see more structured products come to market. Retail users, I don't know if they understand the importance of it. As I think we were saying before, it's a reactionary thing where something bad happens and then someone goes, oh, I wish I was insured. People have to value it ahead of time and realize that it's something real to be considering on these assets. Especially as people buy these assets, and the bet is so asymmetric here, right? They're not buying crypto because they think it's going to go up 5% a year. They're expecting hundreds of % of return over a few year horizon, whatever it is. And so for them to repurchase that same level of exposure years after they first enter the space may be impossible because it becomes outsized in their portfolio relative to whatever else they have in their life. And then they go, well, I can't buy back that crypto exposure. I just lost everything. Now what? And so you have to, early on, when you're putting in money that may only be a few $1,000s or a few $100s or whatever it is, realize that that's going to grow into something quite meaningful. And what are you going to do to ensure that you continue to have that, there when you need it and you don't step in the mud, in the wrong way, which in the space is very easy. If I look back at everything from kind of late 2012 or 2013 till now, there are so many things that have gone wrong in the space, whether it's an exchange blowing up, you have the DAO hack in 2016, you have all sorts of the bridging things that we've spoken about. Maybe you sent to the wrong address, you lost your seed phrase. There's so many ways that this can go wrong that one of the things that I kind of jokingly say to my friends is just do nothing. Literally just go buy a bunch of Bitcoin and go buy some ETH and look away for 5 years. That is your lowest risk way of getting a very good return. The second you start getting cute and trading and touching this and moving your assets around here and in this wallet and then taking this token and putting it there, I'm like, just understand you're trying to juice out a few extra % return, but how much more risk are you taking? And people don't have a way of judging how much risk they've stacked into this whole process. And you saw this a lot with, I remember specifically commenting to some friends that were running DeFi funds where they wanted these neutral strategies of we're just going to play with stables and try and return somewhere between 7 and 12%. And I thought that was completely insane. That you're going to take on all of the downside risk of crypto, all the bridging risk, all the custody problems, all of the L1, L2, you're jumping here, doing that to try and make 8% on an asset, the underlying asset that fine is volatile, but you're going to miss out on all that upside, but you're carrying the same downside risk for the 7%. That makes no sense to me. And I did have a friend who, in the end, unfortunately, was holding a bulk of their assets on FTX, and basically there went the fund. So it wasn't a DeFi protocol, but I was like, doesn't matter. My point still stands that you tried to make 7% and you did a bunch of things along the way. Why? People are very underweight the risks in crypto.
Yeah. Well, I want to switch it over and chat about the tokenization of, I hate saying this, but it is always the real world assets. We at Names like to think that we're launching insurance as an asset class where people can actually participate in it. It can be tokenized. They can actually trade. It's a liquid market now. And so, what do you, I read an article that mentioned, you said, the age of tokenization of this real world assets, is coming. So what are you excited about that has already been tokenized and, maybe what's to come?
I think we are entering the era of tokenization, and that's going to be a part of the next cycle. We've seen tokenization of dollars has arrived. It's successful. Visa continues to make waves with their announcements on what they're doing with USDC. And we'll see more of that. Now the question is, Are we going to start tokenizing stocks, bonds, derivatives, real estate, things that people have known about? I think in 2017, 2018, in that era, people were trying to figure out how to secure, what was the company called? Securitize. I think it was called Securitize.
Yeah.
I remember being a really hot company in that era who said we should be doing all these things. And it always seems to hit this wall, at least in previous cycles. And I think part of the wall was that the two worlds are a little bit incompatible. When you tokenize real estate, the title really still is this kind of paper and computer process in a local jurisdiction. And a fundamental question about tokenization is going to be, does the token on the blockchain act as a digital bearer asset or not? Mm-hmm. And this is where there's kind of a bit of a headbutting going on, because if it's not a digital bearer asset, then it can't be used with quite the same flexibility inside of DeFi. You can't trust that it got deposited into Maker, and then what happens if someone says, well, I lost my token, and then the issuer says, no problem, we can just reissue it. Well, then it doesn't work quite the same way. Mm-hmm. But maybe it doesn't have to be that. Maybe it doesn't have to be quite a digital bearer asset for it still to exist on chain. Some of that will play out, but maybe we're going to start to see L2s spin up, and you guys probably have better insight because you're following the tokenization story far closer than I am. But maybe you're going to start to see these L2s spin up that are private, that just kind of turn into roll-ups down to ETH-L1. And so inside of those private environments, it's not such a big deal. They're just saying we're going to replace the DTCC with this new technology because it's still better for us. And we can settle up with our customers this way, much like Visa saying we should just use these tokenized dollars on a blockchain instead of SWIFT and all that nonsense because it's 2023. So we've seen in the last couple of years the big investment banks in the US start putting out very thoughtful research. They